All right, good evening, everyone. Thanks for having me. I'm Richard Kellam. I'm the CEO of a company you see on the screen here called Data Communications Management Corp. I've got James Lorimer, our CFO, here today. We're a TSX company, and I'll tell you our story. I'll spin through it quickly, and hopefully there's a bunch of questions for me after. Forward-looking statement, obviously. Pretty standard boilerplate here. I will be probably giving some leading information, so please don't act on it. So a little bit about DCM. We are a large, in fact, the second largest, we call it tech-enabled. I'll give you a little bit more detail on that in a minute, but a marketing communications services company in Canada. Okay, so largest would be Transcontinental, who you guys know from this market, which is about, James, what, $2.5, $2.6, $2.7 billion business. And we're close to around $500 million in revenue. And I'll talk to you about how we go to market and exactly what tech-enabled means in a second. Our head office is in Toronto. We're in Brampton. We've been around for over 65 years, so we're been around for quite a while, and our market cap is around 100 million. EBITDA, as you'll see, is around 65 million in 2024. Okay. So a little bit of our story here. If you look at that bubble on the left, 480 million in revenue. So I said close to $500 million. We grew at 7.2% last year. We did a sizable acquisition. I'm going to talk about that in a minute. We've got roughly 1,400 employees. I'll give you some details on that. We really work at the enterprise level, so think of large Canadian organizations. I mean, National Bank Tower's just over here. We do a ton of work with National Bank. But 400 clients represent about 93% of revenue, and then, of course, we've got a long tail beyond that. And we've got a bunch of different printing facilities across Canada, and you can see the 64 million in profitability we delivered in 2024, about a 20% growth over a year ago. So what do? We do a lot of personalized communications. Let's think of direct mail that you may get in your mailbox that's hyper-personalized to you. It could be for a pre-authorized credit card, or it could come from a not-for-profit organization, or it could come from a membership program. So think of all that work. We do all that. We do a lot of business process outsourcing. So think of large banks that maybe have 1,200, 1,300, 1,400 branches across Canada. Anything you see in that branch, we're providing that service to. The entire kind of workflow, including the printing and distribution and installation of the product. And then, kind of endless marketing solutions as well. The market in Canada is a large market. As I said, it's a highly fragmented market as well. It's about a $10 billion market. A lot of people think that print is dead. But have a look at your mailbox and walk around and have a look at retail, and you'll still see a lot of print out there. In fact, in several, we call them profit pools, in several segments of print, they're growing segments. The only market in print that is actually in a secular decline is maybe statements that you get to your house, bank statements, utility statements. A lot of that is moving to digital. But certainly retail is growing, QSR is growing, hyper-personalized direct mail is growing. So a lot of growth opportunities in the market as well. As I said, we work with 400 enterprise clients, and we like to say we help simplify their complexities. The more complex an organization, like a national bank down the street here, the more value we can bring to that organization. So we're not a single SKU long-run producer, right? We don't do 1 million impressions of one thing. We do 1 million different things, and that's how you create value in this market. That's how you drive margin, right? The more complex a client, the more value you can create. A little bit about diversity of our business. If you look at the pie chart on the left, you can see that we work across a multiple number of verticals. The largest is the FI vertical, and we're doing work with every Tier 1 bank in Canada. So Bank of Montreal, TD, Scotia, Bank of Nova Scotia, Royal Bank, we do work with all of those guys, a bunch of different things for all of them. And you can see the diversity we have. Retail would be our second largest, so we're working with the likes of Shoppers and Metro here in Quebec, Rona, Loblaws, et cetera. So tons of retailers across Canada. So lots of diversity in terms of verticals and lots of diversity in our client list as well. We don't have a single client that is more than 6% of total revenue. Okay, you can see our top 10 clients represent 30%, but a lot of diversity between verticals and a lot of diversity between our client base as well, which obviously gives us some confidence in the marketplace. We're not, all our chips aren't in one basket, so to speak. We you talked about earlier, we actually just implemented a quarterly dividend, and we also did a special dividend of 20 cents. We actually just paid that out yesterday, right? 25th of March, and that was to all shareholders that were shareholders as of, I think, the 10th or 11th of March. But we are committed to dividend. We see a great kind of opportunity to return to shareholders. And a little look at our results. I actually joined the company. I spent at close to 40 years, actually, in consumer goods, so consumer packaged goods, and ran a bunch of different businesses in different parts of the world. I lived outside Canada for 18 years, but longest was with Mars Incorporated, a large, you guys probably know, $50 billion private company, and I ran a bunch of different businesses for them. Joined DCM 4 years ago. No experience in print, by the way, but obviously I had experience in communication side, on the buy side. Came in and we were about $235 million in revenue when I joined, and you can see 4 years later we're $480. We did a sizable transaction. We actually bought our biggest competitor, which is a company called R.R. Donnelley, or it was traded under a company called Moore Canada Corp. So we bought our biggest competitor, and that transaction happened in 2023. And you can see I'll talk about some of the synergies we delivered in a minute, but you can see that we're at 480, kind of well on our path to get north of $500 million. So our CAGR, obviously, as a result of that acquisition, was 26.8. But I will point out that 2022 was a clean year. We actually grew 16% organically that year, pre-acquisition. So we know how to grow, and we certainly know how to integrate acquisitions as well, which is a lot of the experience I had in my prior world. So gross profit margin is good, is solid. We were actually about a 30% gross profit. You can see the increase that we drove over the years. That little blip you see in 23 and 24 is the DCM organization pre-acquisition was 30%. We actually acquired a company that was 20%, so kind of net out to 25. And we're on a path back to 30, and we've got a clear path to get back to 30 in short order. And you can see we delivered up to 27.1. Again, that was 25 if you look at the average when we acquired. So we certainly know how to drive margin creation in this business. And a lot of that is what I said earlier, doing highly complex solutions for clients. That's where you create value in this industry. Adjusted EBITDA at $64 million, up considerably over a year ago, and up over 3 years, obviously as a result of that acquisition. And you can see we're pre-acquisition, we're sitting around 15%, and we're certainly on a track to be north of 14 as we progress through this year. Revenue by reported segment. I won't spend a lot of time on this, but you can see that a significant portion of our business comes from what we call physical print. That's the production number there, the 418. But we also have a digital business as well, about $20 million in digital solutions that we bring to clients, up from $5 million a few years ago. If that were a standalone business, it would be valued very differently than being integrated in total print. But a lot of the, back to the point I said earlier, a lot of the value we bring to clients is enabling the workflow with digital technology, right? So simplifying their complexity with technology. So we've got a good digital stack that allows us to win clients and then support those clients with their workflow. It also creates what we call very sticky revenue, right? The more tech-enabled your revenue is with a client, the harder it is for them to kind of lift and shift and move it elsewhere, and generally the higher the margin. And then I did reference the number of associates that we have in the business. We know how to drive productivity. If you look at this chart here, you can see that at our peak pre-acquisition, we were about just under 1,900 associates. And we are now at 1,422, and you can see the productivity per associate's gone from roughly 300,000 to 337. So good progress over time. We know how to deliver results, and that was all a result of physical integration in our business over the course of last year. We committed to $30 to $35 million in synergies as a result of the acquisition, and we're on track to deliver those. And that's based on the $480 to $500 million in revenue as well. And those are all what I call hard synergies: operational, organization, and procurement. And then there's some soft synergies that will come through as revenue continues to grow. So we've built what we feel is a real solid platform for profitable growth. I'm not going to unpack this slide here, but the integration activities or initiatives are behind us. We literally closed 4 factories, displaced 450 people, and built a much better business in 2024. Remember, the acquisition is in 2023, so the activity was all in 2024. All that activity is behind us, including integration of ERP systems, which is a heavy lift, as you can rightly imagine. But that's all behind us, and we've now built a platform that we're very focused on growing off of. We got strong growth objectives, and we got a good balance sheet to allow us to grow. Obviously, cash flow is good in this business. We talked about debt earlier. We've deleveraged considerably post-acquisition, and we've got good credit facilities available. And as I said, we've got good cash flow in this business as well, especially as we continue to improve margins and with the integration work that we've completed. We've got a lot of synergies in action. I'm not going to unpack this page, but there's a lot of activity that's happening and some good capabilities we acquired from our competitor. And we've got some new capital we invested in 2024. As we closed 4 factories, we invested in new capital. I'll give you an example. This kit on the far left, we had a facility in Trenton, Ontario. We replaced 8 presses with 3. 3 of these, they're called OMETs, to do existing production for clients, and also brought brand new capabilities in. So we're kind of in the prime labeling business now. So lots of capabilities that we've invested in over last year as a result of the acquisition and integration. And then I think this is an important one because a lot of questions I get is, look, print is dead. How do you grow? Right? How do you grow? Well, as I said, have a look around and see how much print is still in the marketplace. But I can tell you how we will grow is we're very strong, as I showed you, in FIs. About 27% of our business is in FI. Retail, about 16, 17% of our business. So call it retail and grocery. But automotive is an example. And walk into a dealership, although I see Trump just put 25% tariffs on product going south. But walk into a dealership and you'll see a lot of print in those dealerships. And you'll get a lot of direct mail from automotive manufacturers. You buy a car, you get a direct mail the next day, right? Thanks for your purchase. So there's a massive amount of paper and a massive amount of complex workflow in automotive. And we literally have a very modest and minor share of that market. So that's a huge opportunity. QSR, we're pretty active, but lots of opportunities for share growth. Fuel and C-stores is an example. 12,500 gas stations are across Canada. We have almost 0 penetration in gas stations. So there's so much opportunity. There's endless opportunities for us to continue to grow just by bringing the skill and capability we have in some key verticals and applying those to new. And that's where our team is focused on, our commercial team. And then again, I won't get into the details here, but we've got a couple of pure play SaaS solutions, one being a digital asset management solution called Assemble. And we just converted actually a large FI onto that platform, and we're getting some good traction in market. And we actually acquired a little company out of New Zealand. I saw you had an investment in New Zealand called Zavi, which is a social media analytics platform. So think of trying to understand how your social activity compares versus your competitors. So if I'm a Bank of Montreal, I can see how I'm performing versus a Scotiabank, a TD, et cetera. It's a cool little platform. They built a nice business in New Zealand, but New Zealand's a small market, so we're now bringing that to the Americas. Our priorities are very clear for 2025. One is get back into profitable growth. We built a great profitable platform to grow off of, and now it's a matter of showing that growth to the marketplace, and we've got lots of opportunities in our funnel right now. Deliver on new capital, return on the new capital investment. I showed you some of the new capital. Continue to drive that gross margin improvement, get it back north of 30. As I say to the team, gross margin is your best friend. So we are driving that gross margin. As I said, we acquired a company at 20. We were 30. We knew how to get to 30. We were 23 a few years ago. We got to 30, and we're well on track to get back to 30. 27 we reported last year. And then demonstrate agility and adaptability in this uncertain economic time. And I think we've got a great leadership team that is demonstrating that. So those are our priorities. And then long-term objectives, continue to grow kind of north of 5, continue to drive that gross profit improvement, and EBITDA north of 14%. And I think I'm just going to close on this one, which is ownership. You can see that our ownership, directors and officers, about 26, 27%. ESOP is, associates, our share program. And then KST is, think of it as a family office, friendly, and they've got, just under 10% as well. And then we have a few major institutional shareholders on the left there. Okay? Market cap, I said about 100 mil. We're trading at $1.80 today. So clearly, some opportunities for some expansion opportunities on that share over time, I think. I'm a big investor myself. Obviously, I put my money where my mouth is, and we see good opportunities for value creation over time. There's the highlights. It's a good market. I think we've got a track record of success. We just literally integrated a company of similar size and successfully delivered 30 to 35 million in synergies. And we know how to grow. We've proven that pre-acquisition, and now it's about getting back to market and accelerating that growth. And then we have a very experienced leadership team. As I said, I'm new to the industry. I'm 4 years into it, but 40 years kind of on the buy side of this stuff through my consumer packaged goods experience and experience in acquisitions. But we've got a very seasoned team of skilled people that understand the industry very, very well. Including James, you're what, 10 years in now, I think, right? Okay, so that's it. Am I on time?
Yes, you have about 5 minutes for questions.
5 minutes for questions. Okay, so you said 20. Okay. Questions, yeah.
You said that you differentiate yourself from the competitors because you're doing that complexity, complex thinking. Can you give examples? And if you have
Yeah, and I could give you a bunch of examples, but I'll give you a real simple one. A large bank, I won't tell you who it is, 1,200 branches across Canada. We mapped the physical attributes of every single branch, right? Because branches it's not like Tim Hortons where they have 6 different store designs or restaurant designs. Branches are all different. So we actually have the physical attributes of every single branch across Canada. So we know exactly what's required from a communication standpoint, branch for branch. And we print, kit, and fulfill by branch. So there's no waste in the system, right? So if I'm putting something into that branch over there, I know exactly what's required. How many posters, what's on the floor, what's on the wall, what's on the window, what's on the door, what's behind the counter, right? So there's zero waste in that. That is technology that enables that workflow, right? And we have a platform that we developed to enable that. We call it OptiChannel. So there's a simple example of bringing value, right? A lot of competitors most competitors can't do that, right? They would maybe have 3 or 4 different kit sizes, right? Store type A, branch type A, branch type B, branch type C. There's one example, kind of a simple example to understand. But there's many examples outside of that. Private wealth advisors. I'll give you one other example. And we work with several companies, but if you're a private wealth advisor, you're communicating to your clients on a consistent and regular basis. You may have 2,000 or 3,000 or 4,000 emails you need to compose. We help compose those using automation. So it looks like it is personalized, but it's using data to personalize. So it's instead of writing 3,000 or 4,000 emails, you write one, and it looks like you're writing 4,000. Yeah, look, there's a lot of opportunity for M&A in the market, in the industry, but right now we're focused on organic growth, right? We see huge opportunities in the market. I showed you some verticals as an example, and we built the perfect platform for us to grow off of. Not to say we're not, deals come to us all the time, but right now we're relentlessly focused on driving organic growth now that we've built this great, growth platform to platform off of. If we do, if we are interested, there's a lot of opportunities for further consolidation in the marketplace and some interesting stuff out there. No, not at our scale. I mean, you could say that Transcon has been a consolidator, and a lot of their consolidation of recent has been more in the packaging space, which we don't play in at all, by the way. We don't do anything in packaging. But and then I guess Supremex has been, and you guys probably know Supremex, public company as well. They've done some consolidation, and their recent consolidation has been more in the packaging space as well. They're strong in envelopes, and they've been kind of diversifying into packaging through acquisition. Yeah. Another question? Yeah.
What would make you an acquisition target in the spirit of the first presentation?
Yeah, no, listen, I guess I mean, it's a great question, right? Either, continue to grow and acquire or be acquired. I think we'd be a very attractive acquisition target to a large, multinational, either a large North American multinationals, and there's several outside of R.R. Donnelley. I mean, we bought the Canadian division. R.R. Donnelley was a $4.7 billion company. We bought their Canadian division. But there's lots of competitors to R.R. Donnelley that aren't in Canada. So we'd be a good platform for them to be able to platform off in the Canadian marketplace. And then there's some large European companies as well that may want to use Canada as an entry point to North America. So we could be very attractive. We're not, obviously considering that, but yeah, we could be very attractive. There are some larger companies that would be very kind of strategic players. And then, of course, there's private equity roll-ups that are happening as well that could be of interest at some point. But great question. Okay.
Can I ask the last one?
Yes.
What do you think investors misunderstand the most about your business?
What do they misunderstand? Well, I think there's a lot of investors that look at the print category and think that print is dead to begin with, right? And I understand that. But again, what we understand about the print business is not every profit pool is treated equal. We want to play in the high value, highly complex areas, and many of those are growing. As I said, the only real headwind in print is what we call transactional print, right? Stuff that you may get, statements you get. So I think they don't kind of understand the category well enough and think that, yeah, it's kind of a low growth, slow growth, no opportunities, and we like to think differently. There's a lot of opportunities, and that's what we're leaning into. Okay?
Thank you.
Thank you. Appreciate it.